What's going on, everyone? I'm Bob Boxler, the infill guy, and I've got a quick, simple, straightforward, honestly, it's probably the most valuable lesson to take away, however. So I want to go back in time. If you haven't watched the first couple episodes, go do that. But honestly, this should have been the very first episode because right now, in the world of real estate, if you're paying attention at all, things are not all green and starry eyed at the moment. We've got rates climbing, interest rates are climbing, we've got buyer demand dropping, and we've got more and more sellers coming on the market and staying on longer. We're coming out of this period where there were so few sellers that buyers had to compete for the very few sellers that are on the market. That pushed prices sky high. Now we are transitioning by design. The Fed is actually pushing the whole economy this direction, housing especially. They need to slow it down. So the Fed, by raising interest rates, is actually purposely crushing demand. So we are going to see rates continue to climb. We're going to see buyers continue to drop out, fewer buyers. And we're going to see sellers continue to increase. Listings are going to climb, the number of listings available. So that situation we just described, flip it on its head. We could and we will enter some variation of a situation where there's a lot of listings for sale and available, and there's only a few buyers out there ready to buy. So what's going to happen in that environment? The sellers are going to compete for the buyers. So they are going to put pressure downward on prices so that they can get chosen, hopefully get chosen by the very few buyers that are out there. Completely different dichotomy. So pressure on prices is down right now, and it's going to continue to get bigger and bigger pressure in that direction. Okay, so what does that mean? Well, you've already heard I'm not a huge fan of flipping houses. And in fact, I'm staunchly almost against flipping a house. I want to buy things, and I want you to buy things where this fundamental truth holds always. And it's so simple. You're gonna laugh when I say it. But you'd be surprised how often this rule, and I would call this a rule, you'd be surprised how often this rule is violated out there in the world. It's violated every single day, countless times, and a lot of people are going to have some pain because of it. And I want everyone to win. I want everyone to make money. But if you bought a property strictly as a flip, there's a lot of people right now that are pinched. They're getting pinched where the ARV, the value they shot for at the end, isn't quite there, or the project took a little too long and they've spent too much money, and they'll either break even, make less than they thought they would, break even, or maybe even lose a little bit of money doing these projects. This strategy right here is going to help you avoid all of that pain. All right, without further ado, it's very simple, friends. If you or I ever buy another piece of real estate, make absolutely sure that there's a path with long-term financing in place. At least 5 years. 5 years is short though. Shoot for 10 years or more financing. If you go to the bank, they're going to give you a 30-year amortized loan. Great. 30 years is an incredible amount of time. There are other situations where you can negotiate or sign up with another lender for a smaller term. Get at least 10 years term on your debt and run your numbers. Sure, maybe you're going to flip this property. You're going to get in, fix it up, and get out for a higher price and make that money, stick it in the bank, go do it again. Great strategy. But do not buy that deal if the market changes and you can't sell it for a number that would work for you, you're not dead to rights. That's okay. You just turn around, take a deep breath, prep the property for rent, place a renter in the property, and lease it up. If the rent rate is large enough for this piece of real estate that I'm thinking of buying to cover insurance, principal, insurance, taxes, and insurance. Also, any utilities that I'm obligated to as the landlord. Look at other listings around you for rental listings to see if the landlord is covering utilities or if the tenants are covering utilities in your market. Any utilities, hold back at least 10% for maintenance, and I add 5% on top of that as well for vacancy. Like if I need to spend 1 month renting up this unit, so it's vacant for 1 month out of a year, that's automatically 8% vacancy. You follow that? 1 month out of 12 is just over 8% vacancy. So I factor 5% because I'm betting on myself to be fast at turning these things around. And in my marketplace, there's a lot of demand for rentals. So typically I'm able to achieve under a month of vacancy per year that I own this property. But so build yourself a little cash flow spreadsheet. Here's your income, the rent that should come in from market rents that you study. Here's every expense you can think about that you're going to pay for. Are you going to pay for landscaping as the landlord, or do the tenants need to take care of the yard? Pretty simple question to ask, but if I'm going to pay for it, well, I better budget $80 a month for my landscaper to go trim up the hedges and mow the lawn twice a month. Whatever it is, break it down. It's super simple. Just go to the simple nuts and bolts. What are the expenses we're going to see? And pay your mortgage. And does that break even or better? If the answer is yes, after holding back for all those expenses, then buy the deal. Because if you have long-term financing, 10 years or more, and the rent will cover all those expenses and you at least break even, this is not getting rid of all the risk, but that's about as much of the risk as you can engineer out of this equation as possible. That means green light, buy this damn thing, get it fixed up and put it back on the market, sell for a big profit. Or if you can't get a number that you like and want to sell at, no problem. If the market changes, no problem. If a meteor hits some part of the country and everyone freaks out, or a bomb goes off, or the flood comes into town and things just get crazy, no problem. Put up the for rent sign and lease her out. Just break even until the market comes back or until values come back. And in the meantime, go out and continue doing business, buy more, sell more, invest more. As the market changes, you're kind of dollar cost averaging yourself into the marketplace, the real estate marketplace. I always, and I want you to always be looking to buy. Sure, we can sell sometimes when the market is good and you can get what you need to get onto the next stage, but always be looking to buy. Low markets, definitely want to be buying. High markets, we still might want to be buying because you can work out terms that work for you. You could find a way to push the value into the deal. And also, you don't know, nobody has a crystal ball. We might just see a little blip here and continue. Rates might get dropped next week because of any of those crazy events that I just mentioned might happen. And the Fed might say, well, flipping the switch back to zero interest rates. So the feeding frenzy could continue and prices might shoot back up. We just don't know. But I know that personally, I don't want to buy any deal that I couldn't turn around and just put a renter in and hold on to and ride out the storm. If you never sell, you never lose. So there you have it, friends. I hope you got a little bit of information out of that short. Like, it's so simple. It's a foundational philosophy that I want you to adopt. So I hope you got it. I hope you absorbed it. Hope this was helpful. Tune in next time and we'll see you then.